our knowledge series on corporate tax in UAE. In this video you will learn about the tax loss relief. This video covers the requirements to offset tax losses. Introduction. Where a taxable person makes a tax-adjusted loss in a tax period, then it is either available for carry forward to adjust against taxable income of future tax period under Article 37 of Corporate Tax Law, or it can be transferred to offset against taxable income of another taxable person under Article 38 of Corporate Tax Law. Carry forward of tax loss. The figure against which tax loss is claimed will be taxable income before loss relief as per Article 20 Clause 2, f, of the Corporate Tax Law, and this should be the final adjustment made when calculating taxable income. Restriction of offset. Under Article 37 Clause 2 of the Corporate Tax Law, there is a cap on the amount of taxable income which may be offset in any tax period by a tax loss brought forward. The offset would be the lower of loss brought forward, and 75% of the taxable income of the tax period in which the loss is being offset. Unutilized tax losses may then be carried forward. Timing of offsets. Under Article 37 Clause 4 of the Corporate Tax Law, any tax loss carried forward must be offset against the earliest available future taxable income before any remainder can be carried forward to the following year. This is an anti-avoidance provision as there is no choice about when to use a tax loss brought forward. In this way, a company cannot select the most advantageous tax period for offset, nor can a company restrict the use of losses to ensure that they are only offset against taxable income that is taxed at 9%, which would mean that some of the loss would not save any tax as the taxable income would have been liable to corporate tax at 0%, for instance taxable income up to AED 375,000. Continuity requirement. Article 39 Clause 1 of the Corporate Tax Law stipulates further anti-avoidance provision to ensure that tax loss benefit can be claimed by the same business in which the brought forward loss arose. This is achieved by requiring the following. At least 50% of the company's shares must be held by the same shareholder or shareholders from the start of the tax period when the tax loss was incurred until the end of the tax period in which that tax loss is to be offset against taxable income, or, if ownership of more than 50% of the shares changes during that time, the company must carry on the same business, or a similar business or business activity after the change in ownership. This provision prevents, for example, a loss-making business is sold to an unrelated party for using the brought forward loss against taxable income from a different business. Further, a change in either direct or indirect ownership is relevant for these purposes. For example, a company's immediate owner may be another company which itself is sold to another parent company. Under Article 39 Clause 2A and 2B of the Corporate Tax Law, relevant factors for determining whether the same or a similar business is continuing after a change in direct or indirect ownership include use of some or all of the same assets as before ownership change, no significant changes to the core identity or operations of the business. As per Article 39 Clause 2C of the Corporate Tax Law, where there have been changes, it will still be possible to use losses brought forward where the changes result from the development or exploitation of assets, services, processes, products or methods that existed before the ownership change. This means that a business will not automatically have restrictions imposed on its brought forward losses if it makes changes in order to remain competitive in the light of industry developments, or to make use of new technologies to seek out new opportunities and ventures in an attempt to return to profitability position. If a business or business activity changes its core characteristics, or if there is a change as a result of either the commencement, the acquisition, or the cessation of activities, then the new business or business activity may not be considered to be the same or similar to the previous one. Continuity requirement for listed companies. Article 39 Clause 3 of the Corporate Tax Law states that the aforementioned continuity requirements do not apply to a company which is listed on a recognized stock exchange. This is because shares in listed companies may be bought by any member of the public. Ownership may be widely spread, and this is integral to the way a listed company raises capital. Further, the directors, not the shareholders of a listed company, make the key management decisions. We have covered loss carry-forward provisions within one company which is continuing the same trade. In the next video, we shall be discussing transfer of losses to another taxable person. This ends our video session. Subscribe to our channel, and click on notification icon to stay tuned to the series of valuable material that will cover all aspects of the UAE corporate tax. Our partner is available for free consultation who is holder of FTA-approved UAE corporate tax qualification. His contact details are provided here. Visit finexcel.ae. Navigate to our clients and testimonials webpage to see more clients' review on our services and our major clientele. Contact us for more detail. FinExcel. We create value that matters.